video, I will explain why AstraZeneca's stock price has dropped 30% from its peak and show you if this presents a golden opportunity or a dangerous trap. If you're interested in healthcare stocks, you won't want to miss this analysis. Hey friends, welcome back to the channel. I am Iggy here, and I've been covering topics such as stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've covered over 500 videos and over 250,000 watch hours as of September 2024. Stock performance overview. Let's dive into the numbers, shall we? AstraZeneca's stock has taken a pretty significant hit, falling from its peak of 13,388 GBP back in September to around 10,024 GBP today. That's a drop of over 3,300 GBP, or roughly 25%, definitely enough to raise some eyebrows among investors. Now, I know what you're thinking. Is this a buying opportunity or a sign of more trouble to come? Well, let's take a step back and look at the bigger picture. AstraZeneca is still one of the largest pharmaceutical companies globally, with a current market cap of $196.96 billion. To put that into perspective, the global pharmaceutical market is projected to reach $1.7 trillion by 2025, growing at a CAGR of 6.4% from 2020 to 2025. So AstraZeneca is definitely a major player in this space. Now, when we look at AstraZeneca's financials, we see that the company has been investing heavily in research and development with a focus on oncology, cardiovascular, and metabolic diseases. In fact, AstraZeneca has one of the strongest pipelines in the industry, with several promising drugs in late-stage development. The company has also been actively pursuing partnerships and collaborations to expand its reach and capabilities. For example, its partnership with Merck to develop and commercialize certain cancer treatments has shown significant promise. So, while the stock price may have taken a hit, the underlying fundamentals of the business remain strong. The question is, will AstraZeneca be able to execute on its strategy and deliver growth to shareholders? That's what we'll be keeping a close eye on in the coming months. Recent financial performance. Let's take a closer look at AstraZeneca's recent financial performance, shall we? The Q3 2024 results are truly impressive, with total revenue reaching $13.57 billion, marking a 21% increase year over year. That's a significant jump, and it's clear that the company's strategy is paying off. But what's even more impressive is the company's core EPS, which jumped 27% to 280, significantly beating market expectations. This tells us that AstraZeneca is not only growing its revenue, but also improving its profitability. And if we look at the first 9 months of 2024, the picture becomes even clearer. Total revenue has grown by 19% to $39.18 billion. That's a remarkable achievement, especially considering the challenges faced by the pharmaceutical industry in recent years. Now, let's dive deeper into the performance of AstraZeneca's various divisions. The oncology division remains the company's crown jewel, and for good reason. In the first 9 months of 2024, it generated $16 billion in revenue, up 22% from the previous year. That's a staggering growth rate, and it's clear that AstraZeneca's focus on oncology is paying off. The biopharmaceutical sector isn't far behind, bringing in $15.9 billion with a 20% growth rate, and the rare diseases segment is also showing promising growth, contributing $6.4 billion with a 14% increase. These numbers tell us that AstraZeneca has a diverse range of revenue streams, and that its strategy of focusing on high growth areas is yielding results. As investors, this is exactly what we want to see: a company that's growing its revenue, improving its profitability, and executing on its strategy. Strategic growth initiatives. AstraZeneca is clearly not content with its current success and is actively taking steps to ensure its future growth. One of the most significant moves the company has announced is a massive $3.5 billion investment in the United States by 2026. This investment will focus on boosting manufacturing capabilities and research and development, which is music to the ears of investors like us. By expanding its presence in the US, AstraZeneca is not only increasing its market share, but also demonstrating its commitment to innovation. This move also shows that the company is willing to put its money where its mouth is, investing heavily in its future growth prospects. And speaking of growth prospects, AstraZeneca has set an ambitious target of reaching $80 billion in revenue by 2030. Now, that's a big number, but considering the company's current growth trajectory, it's definitely achievable. The fact that AstraZeneca is thinking long-term and making strategic investments in its future growth is a huge plus in my book. It's clear that the company is not just focused on short-term gains, but is instead taking a holistic approach to its growth strategy. By investing in manufacturing capabilities and R&D, AstraZeneca is setting itself up for long-term success. And let's not forget, the pharmaceutical industry is expected to continue growing in the coming years, driven by an aging population and an increasing demand for healthcare services. So AstraZeneca is well positioned to ride this growth wave and achieve its ambitious revenue targets. As investors, this is exactly what we want to see. A company with a clear vision for its future, a solid growth strategy, and the willingness to invest in its own success. The China Challenge. Now let's tackle the elephant in the room, the recent stock price decline. It's no secret that AstraZeneca's stock has taken a hit, and a big part of that is due to the investigations in China involving their executives. Specifically, their China president, Lian Wang, was detained last month, which has created a lot of uncertainty and raised concerns among investors. However, it's worth noting that AstraZeneca has been proactive in addressing this situation, appointing legal representation and cooperating fully with the authorities. This suggests that the company is taking the situation seriously and is committed to transparency and compliance. While this situation is undoubtedly a setback for AstraZeneca, it's essential to keep things in perspective. The company has a strong track record of operating in China, and its business in the country has been growing steadily. In fact, China is one of AstraZeneca's largest markets, accounting for a significant portion of its revenue. So, while the current situation is certainly a challenge, it's not necessarily a reason to panic. AstraZeneca has a robust business model and a diverse range of revenue streams, which should help it weather this storm. As investors, it's essential to take a step back, assess the situation objectively, and not let short-term volatility dictate our investment decisions. By doing so, we can make more informed decisions and avoid making emotional mistakes that can hurt our portfolios in the long run. Market position and competitive advantage. AstraZeneca's current PE ratio stands at 30.32 with a forward PE of 13.80, suggesting potential undervaluation. The company offers a dividend yield of 2.33% with the latest dividend payment of 1.48 per share. Analysts maintain a buy rating with a price target of 88.80, indicating a potential upside of 39.19%. The company's pipeline remains robust, with several promising drugs in late-stage development. Their expansion in emerging markets outside China has shown remarkable growth of 30% year-to-date. The weight management program and rare disease treatments present significant growth opportunities. Free cash flow has improved substantially, reaching $942 billion in Q2 2024. The company maintains a healthy balance sheet with a net debt to EBIT ratio of 1.8 times. Operating expenses have increased by 15% due to R&D investments, showing commitment to future growth. Investment risks and considerations. Beyond the China situation, investors should consider the impact of the Inflation Reduction Act in the U.S. and potential policy changes following the 2024 presidential election. The recent nomination of Robert F. Kennedy Jr. as potential HHS head has created additional uncertainty in the pharmaceutical sector. My investment verdict. Despite the current challenges, AstraZeneca's fundamentals remain strong. The stock's technical indicators suggest oversold conditions, with the price currently trading just 6.15% above its 52-week low of 9,443 GBP. The combination of strong growth, solid pipeline, and current valuation makes this pullback an attractive entry point for long-term investors. If you found value in this analysis, please hit that like button and subscribe to the channel. And if you're interested in more healthcare stock analysis, check out my video on top 3 SGX healthcare stocks you can't ignore, where I break down the best healthcare opportunities right here in Singapore. If you found value in this analysis, please hit that like button and subscribe to the channel. And if you're interested in more healthcare stock analysis, check out my video